It's time that we really talk about what's going on in the economy. Inflation was 8.3% in the April survey. This is the highest inflation we've seen since the 1980s. And this is also far above the Fed's inflation target at 2%. This is quite alarming. And if the inflation continues to be at this level, it will only take 8 years until your money is only worth half of the current value. 8 years! While at 2% inflation, it instead will take 34 years. A pretty big and substantial difference. In the US, the Fed has the task to control the inflation, and to do this, they can, among other things, change the federal funds rate. But this works similarly in other countries. This interest rate will in turn affect other interest rates, such as the interest rates of your loans. A lot of analysts are trying to predict when the Feds will raise the interest rates and how much they will raise it. Not the least those who are trading and investing in interest rates. An interest rate increase will not only affect those of you with loans, but will also have an impact on, for example, how our stock investments will perform in the future. Also, many foreign stock exchanges nowadays is following the US interest rate announcements more than their corresponding domestic interest rates. Depending on the industry, companies will either lose or gain on an interest rate increase. In general, most companies lose on an interest rate increase, and then their stock price will fall respectively. But what's the cause of the rapid inflation now? We've had decades of low inflation and even with negative interest rates in some countries without inflation rising. What we see now is likely the combined results of relief funds, rising energy and fuel prices, which were caused by the conflict with Russia, which then has spread to more industries. And now most goods cost more, not the least food. The shutdowns in China with supply chain issues as a result also has impacted the situation. What the Feds are afraid of now is that you and I, us working people, will start demanding higher wages as a compensation for the increased inflation. If wages starts to rise, it could set in motion a scenario of rising inflation similarly to the situation we had in the 1970s. At the same time, the economic growth is being slowed down by the higher prices. And this is a scenario that the Feds and other central banks really want to avoid. In the worst case scenario, this can lead to stagflation. In other words, a situation with a recession and high unemployment at the same time as inflation then is high. But how will the Feds curb the inflation and reach this 2% target again? If inflation rises, central banks usually respond by raising the interest rates. This partly leads to us with loans having less money left in our wallets to buy other things for, and on the other hand, companies find it more difficult to borrow capital as well as get higher costs for interest rate payments, of course. And this works great in the usual scenario when the economy is doing well, unemployment is low, and demand for goods is increasing too much. This is called a positive demand shock in economics. In this situation, there is a risk that the economy will overheat and inflation will increase. Then the central banks raises the interest rates, we get less money in our wallets, and then we cannot buy as many goods and the economy slows down a bit and cools off as our demand for goods decreases. Easy peasy, right? And it also works to regulate the interest rates when the economy is slowing down too much. Unemployment is increasing and the demand for goods is falling too much, which we call a negative demand shock in economics. In this case, the central banks can instead lower interest rates and speed up the economy again by giving us more money for consumption and increasing the demand for goods. So an overheated economy means that the interest rates will rise, which leads to lower inflation and higher unemployment. While a too slow of an economy means that the interest rates will be lowered, which leads to a higher inflation and lower unemployment. So a fairly simple relationship. However, this is not really what is happening right now. What we see now is a completely different situation. Now we see something called a negative supply shock. We want to buy things, but there are no longer as many goods of what we want. Since demand is greater than supply, prices rise and inflation is a fact. During the pandemic, it was more difficult to obtain certain goods, such as computers and other electronics that contain semiconductors. Now added on, oil and natural gas are more expensive, and not the least affecting those of you with cars. Electricity prices are expensive, especially for those of you living in Europe. And of course, this also affects industries that are more dependent on energy in these forms. Food production has also been affected, not the least because Ukraine accounts for a lot of grain production, but also because Russia is a major exporter of synthetic fertilizers. And I don't think we've seen the full effect of this yet. Many retailers have long contracts with their suppliers that details lower prices yet, and therefore the price increases are not fully noticeable on store shelves yet. Others have tried to take a part of the price increase themselves without passing it on to the consumers, because it normally takes a little bit longer to change the prices of goods. There's a certain inertia in the system. The prices of goods in the store are thankfully not fluctuating as the prices of a stock, for example. It would be rather unreasonable, even if the cost for the producing company varies more. And after all, some prices of goods cannot be risen as much as producers might want without losing the consumers altogether. But sooner or later, these price increases will reach us consumers as well. To some extent, the inflation increase can revert if the conflict between Russia and Ukraine will be solved. But I also think that other price increases is here to stay, such as the increase in energy prices, for example. Not least because the energy production should become more environmentally friendly at the same time as the demand of electricity then will increase in order to replace oil, for example. So what should the Feds do about the inflation then? And what do many other central banks do around the world? Well, they raise interest rates, of course. But it's not entirely obvious that this is the best solution, and not everyone agrees with this. So will this solve the problem then? No, not very much anyway. Because we will not be able to stop buying food, drive to work, heat our houses, or stop turning on the lights. It's still pretty basic stuff and no luxury goods we're talking about here. Nor will higher interest rates be able to bring down the prices of these goods. We will only get a double hit with even less left in our wallets, both because goods we need are more expensive, but also because loans become more expensive. And a rise of the interest rates will probably lead to a worsening of the economy and an increase in unemployment. And if the interest rates are increased too much, there is a risk of a recession and even higher unemployment. There is a known link between inflation and unemployment called the Phillips Curve, and it mostly holds even if it has been questioned more recently. The Phillips Curve looks like this and illustrates the relationship between the inflation and the unemployment. Now, I've only made up these figures here to show us an example, but here you see, for example, that if the inflation is high, like here, when it's 6%, unemployment is lower, and here in the example, it's then 3%. If we then pretend that the central banks thinks that 6% here is a bit too high inflation, then they raise the interest rates so the inflation drops to 3% and then the unemployment here increases instead to 4.5% in the example. There are those who believe that the central banks shouldn't raise the interest rates at all because unemployment will increase and the impact of the interest rates increase will therefore be greater for fewer individuals, while most of us will gain from the lower inflation. So the few who will become unemployed will have to carry the whole financial burden, while if we don't raise interest rates, we will all share the financial burden more equally. Personally, I'm not sure what's best here. This is not an easy situation, but the central banks around the world is still expected to raise interest rates several times more already this year. So why would they still raise interest rates if it has a fairly limited effect that even risks to making the situation even worse? Well, one reason is that they are afraid that people like you and me will lose confidence in the central bank's ability to control interest rates. And if the central banks can no longer control people's expectations, it's believed that the inflation can really spiral out of control. The banks will therefore raise interest rates in part to show that they still can control the situation. If we no longer expect the banks to be able to keep interest rates at a 2% level in the long run, but instead start expecting higher inflation for a longer period of time, we will also start demanding higher wages as a compensation. Then prices will rise even more to compensate for that, and so a spiral of price and wage increases can drive inflation further. So people's expectations of a long-term inflation of 2% and that we still believe that the central banks can control the inflation is very important to them. Interest rate increases or not, the reality is, in any case, that we and the rest of the world just became poorer. I hope you liked this video, guys. I thought I would test this format again, so let me know what you think in the comments, and I'll see you all next time.